Please remember that nothing we say here should be taken as personal advice. The conversation is for entertainment purposes only. If you have questions about your financial situation, please talk to a licensed financial advisor. All right, welcome to another episode of Future Money, where we talk about the investments of the future.
That would make us money.
Yeah, well, you know who's not making us money right now?
Not today.
Is the Fed. The Federal Reserve, you know. Who would have thought a bunch of...
You just want to dive right in.
Dude, I'm going to go for it. We're not going to mess around. This is the new and improved lean version of Future Money.
Yeah. We had a conversation with our production team that we're gonna bring this down a little bit from
short and sweet. Yeah.
Short and sweet.
But yeah, I mean, you know, the Fed, for a bunch of nerdy academics, they sure do get a lot of media time and a lot of front and center spotlight.
Yep.
And I'm just tired of hearing about them ultimately. But, you know,
yeah.
Let's talk about the Fed. Let's talk about what's going on right now.
Yeah, I think it's important. You know, we hear interest rates. Everyone talks about interest rates, but I don't think people understand why it's so important, right? Mm-hmm. Interest rates basically drive every asset class, right? Yeah. We know for mortgages, you know, higher interest rates just mean that you're more expensive house or mortgage that you have to get. But ultimately, you know, when you think about valuations in general, with the Fed raising rates, what it does, it really reduces the value of every asset class.
Yeah, and I think it's important to know why, right? Like, if I have $100,000 today, you know, normally I can go out, I can buy, you know, stocks and things like that, and you know, in the era leading up to the last, you know, the last decade up until last year, stocks were kind of the only game in town. Real estate was the only game in town.
It's called ZIRP. Zero interest rate policies.
Oh, ZIRP. I actually haven't heard that.
Yeah.
All right. ZIRP.
Yeah, there's nowhere to go, baby.
Yeah. So you had to buy risky assets. But now I have $100,000 and I can go out and buy a 1-year treasury bond earning 5.5% with zero risk.
Yep.
Right. And, you know, we don't get to use the word guarantee a lot in investments.
Yep.
But the federal treasuries are guaranteed by the U.S. government.
Yeah, it's literally we call the safe. This is
the risk-free rate.
Risk-free rate. So the safest asset you can buy, right?
Yeah.
So if I'm getting 5 or 5.5% risk-free, what's my incentive to go out there and buy stock or even a bond or anything else that has more risk than a treasury, right? Yeah. So as a result, as rates go up, you know, the other assets have to provide a lot more return in order for them to make sense, right? Yeah. And that's why interest rates are important. And that's what the Fed is trying to do, is trying to slow things down, to slow inflation. Yeah. So they've raised rates so much, which is, you know, they raised almost 550 basis points in 18 months, right?
Yeah, unprecedented. And by the way, we have a 22-year high now. On interest rates on the 10-year.
Right.
You know, it was reached again in 2007 before the financial crisis, but going back to 1997, I think it was, 1998, something like that we touched this number. So rates are getting high, and as such, the market's getting hit.
Yep. And also, like, long term, though, you know, we are in a restrictive environment, right? Yeah. The Fed, admittedly, they said they don't want to stay here, okay? But they're trying to bring inflation down. Inflation is really bad long term because really that erodes our purchasing power. Yeah. So I think what their Fed is trying to do is try and slow inflation down, and then ultimately rates will come down again.
Yeah,
okay?
Eventually. That's the hope. And they keep moving the goalposts, 4%, 5%, now maybe 6%, who knows? At some point, they have to stop, right?
No, I think we're towards the end. I think you know, there is so much damage that's been done. I talked to some real estate people yesterday. Yeah. It's a bloodbath in the real estate market. There is no doubt about it. You know, unlike traditional residential mortgages, commercial mortgages have to be refinanced every 3 to 5 years.
Yeah.
So, you know, when rates have gone up so much, you know, a lot of the projects that, you know, made a lot of sense 3, 4, 5 years ago make zero sense now from a cost.
They bought at really high, right? At really high, expensive, right? Yeah. You bought a building in 2020, rates were really low, prices were kind of high, right? And now you have to refinance it in 23, 24, 25. Like we're just at the beginning of this, right?
Yep.
Like we haven't even gotten to the real estate.
There's a lag effect. You're absolutely right. There's a lag effect. You know, rates have gone up so much so fast, but we haven't seen them kind of get through the economy. Yeah. And I think and this is why we think it's going to slow down over the next, you know, 6 months or so.
That being said, you know, we've been saying this for a while, but the Fed, you know, correctly has shown that the market is more resilient. The economy has been more resilient. Labor is still good, albeit, today's was kind of a mixed bag. But, we're still in a really good economy. Like all of last year at this point, people were predicting recession. Now we have a 2.5% economy.
The American consumer, baby,
You know what's crazy? Yeah, 2.5% economy is where we were like for a decade. We were growing at 2.5%.
Yeah.
During the the 2010s, so to speak. So,
but arguably though, debt is going up. People are borrowing. Default for used cars and new cars are going up.
Student loans are coming back online, right? Like people have used the money they sort of stockpiled during all the stimulus packages.
I think what happened in America is, unlike most other countries, we printed so much money during the pandemic, and it's just taken longer for that money to be taken out of the economy, right? Yeah. And that's really that's what's going on. We're working through these imbalances basically, and really what the Fed is trying to do is trying to bring us to a normal kind of stance, right?
Yeah, totally.
So that's
very exciting stuff.
Yeah, that's our primer interest rates.
But in general, right, like this is a traditional, in addition to the Fed, obviously rates rising, this is a traditionally weak time in the market.
Yep.
In the year. There's the old saying, we all know it, right? Sell in May, go away. You might have heard that saying in investing.
Worked out this year, no?
It worked out this year. And in fact, according to Fidelity, basically, if you invested just between November and April every year, then you earned about 7%. And if you invested from May to October, you made about 2%.
Yeah, we don't advocate for you.
Do not do this, by the way. Because for a couple of reasons. One is, on average, you still made money during that time. So why would you stay out of the market if you didn't? Right. Two is you try to sell, you pay taxes, you don't know when to get back in.
Yeah.
And three, actually, prior to this year, it actually hasn't worked in the last few years.
Exactly.
So, these adages become a thing. There is seasonality, and it's also kind of like a self-fulfilling prophecy a lot of times, right? You think that the markets are going to be challenging, so, you're less likely to buy investments, etc.
Yeah, and I think also like this year, we had a good year, and the summer is just generally a slower time. People are going on vacation, trading volumes are down. For sure.
Which means volatility's up, right? The less trading volume means that price movements are more exaggerated.
Correct, and you get all the holidays and people just going around. So there is that, and usually October through really April is really the good time. That's why I'm excited. I think we're going through. Last month was a 5% down month for the Nasdaq or so. 3% down for the S&P. Yep. I think that's always good going into a strong season, because hopefully we can see some up momentum from here.
Yeah, totally. And I think we have to talk about the fact that we have the Magnificent Seven or the Elite Eight or whatever you want to call those stocks that everybody wants to buy. Apple, Nvidia, Microsoft. Those, if you strip those companies out of the market, the market is flat for the year.
Totally.
Right. So it really is.
There is something called the equal weight index, which is basically, if you strip out the outsize volume of these big companies, that equal weight index. So you take all the companies.
All 500 companies are all exactly the same weighting, right?
Right, exactly. And that index is basically flat for the year.
Yeah. So it begs the question, and a lot of people will say, with the exception of Nvidia, because obviously they had incredible numbers this year. Right. The idea is mainly that this AI hype has powered a lot of this, because it hasn't been earnings growth this year for Apple, Microsoft. They're actually all down year over year in earnings. So I think it's the hope of the future kind of stuff.
It's an excitement phase, man. I listen, whenever there's a new cycle, this is the excitement moment, and hopefully we'll see that being applied into new productivity, new tools, new ways, and obviously new ideas, right?
Yeah.
So
yeah, totally. So that's a little bit of our Fed, our recap of kind of markets during this time.
Yeah.
Don't worry about it. Again, keep your eye on the long term. Yeah. Don't worry about selling.
But also listen, admittedly at Gerber Kawasaki, we've been buying a lot of treasuries. Yeah. You're getting paid to wait. It's as simple as that, right? But
and we
also
dollar cost average.
Dollar cost average, but also, you know, stuff is down. There's a lot of really great names that are down 10, 15% this summer. So opportunity is kind of out of bound there, you know?
Sure, yeah. But again, you know, don't just buy random stuff because people do that. And when the market starts to go up again.
It's not a risk on time. It's not a risk on time.
But we had a few months where risk was big back on, and, you know, you had your ARCs of the world that people were just like gung-ho again about the stuff. And, you know, this month hits, last month, I should say, and then it all goes away.
Okay.
So you got to be careful.
So let's recap a few stories that actually were dominating the news cycle for us, right?
Yeah.
One is the IPOs. Okay?
Yeah.
IPO market finally came alive. Basically, we had 0 IPOs all year. Capital markets or IPOs are important because it creates kind of liquidity. So new money goes into people's pockets where they can spend and really kind of stimulates the economy. For us investors, new places to invest.
Yeah.
You know?
Yeah.
Before we talk about what happened, for Gerber Kawasaki, our policy here, or our usually what we do is we really don't buy new IPOs.
Yeah.
We wait about 3 to 6 months minimum.
At least.
Before we get in. We want to see more activity. We want to see the company put out a couple of earnings reports. We can understand how it's trading and so forth. Right?
Yeah, I think there's a few things. I want to come back to that to talk about why we don't invest more in IPOs. But let's talk about the companies real quick.
Well, you got 3 big IPOs that everyone was looking for. One is ARM.
For those that have been investing in NVIDIA for several years, either with us or without us, you'll remember that NVIDIA tried to acquire ARM in 2021.
Correct, and
got blocked mostly by the UK officials, from what I remember.
Yeah, Chinese too, I think.
Yeah, well, they'll block anything.
So true.
And it was mainly on the idea of, like that NVIDIA was going to own too much of the chip market and too many integrations.
What ARM does is basically they design chips that are mostly done for mobile.
Yeah. 95% of phones have ARM chips in them, which is a crazy stat.
Yeah.
So really NVIDIA would dominate the GPUs. They would have dominated the mobile market. So
it went public for a little bit over 50 billion, right?
Yeah. Well, let's rewind for a second, right? So NVIDIA doesn't acquire them. Who does acquire them?
SoftBank. Well, SoftBank owned them before.
Yeah.
They wanted to sell them. As SoftBank is really.
Yeah. SoftBank is who NVIDIA was buying. Their track record over the last
hasn't been the greatest.
So
we can literally do a whole episode of SoftBank's shitty investments.
If more people really knew who SoftBank and Mashimoto-san were more, maybe we would have more interest in that. But they haven't been the greatest. So they
tried to offload it, tried to create some liquidity, couldn't sell it to NVIDIA, and then the IPO market kind of opened up a little bit, and they went public.
They went public, sold 10% of the company, basically. Yeah. SoftBank still owns 90%.
Right.
And we'll get back to this in a sec when we talk about it, but this is the point. This is what happens in IPOs is they only unleash a small amount of the shares to the public.
Yeah. I'm glad you brought up this point because traditionally when new companies go public, they try to sell more than 10%.
Yeah.
But these latest IPOs only selling 5 or 10%.
Yeah.
Creates more volatility because there's not enough shares out there for people.
It's been like that for the recent past because, again, so whatever, we're talking about it. Let's just get into it. One of the reasons, several of the reasons we don't like to buy IPOs is this is one of them. They unload a small amount of shares, right? So 10% of the company. They go out, the investment bankers, they hype up the shares, ARM Holdings. Remember when NVIDIA wanted to buy them? It's the most amazing company, blah, blah, blah. And there's excitement, and they generate excitement around it, and they
get a pop.
They get a pop in the stock usually, and this is it's almost like clockwork. It doesn't happen all the time, but there is a good majority of the time where you'll see a pop in the first few days, and then you'll see a come down over the next several months, and then that 6-month number that you talked about, this is a very key number in IPOs because this is generally what we call the lockup period.
Sure.
So if you're in the company before, right? If I work for
insiders,
ARM, right? I'm an insider. I worked for ARM. I'm an executive. Yep. I cannot sell my shares usually for 6 months. Sometimes it's 12, but usually it's 6.
Right.
And then what happens, right? The market opens up. they have a few earnings. Being a public company is very different than being a private company, and how people scrutinize you. It's a fact that I tell a lot of my clients who are in companies when they go public. I go, you're not ready for this volatility. You've been in a smooth ship right now. You're about to hit choppy water. It's real hard. And then what happens is that the floodgates open. You can unload a large amount of shares. Simple supply demand economics.
And if you think about it, a lot of these insiders have been working maybe for many years, and they really haven't had any liquidity. And now, after 6 months, they're able to sell some shares so they can do whatever they need to do, right? Buy homes, blah blah blah. So I think the reality is waiting for that lockup period to be over makes a lot of sense.
Absolutely.
The problem I have is that a lot of the investment banks don't have a lockup sometimes.
Correct.
So they can trade.
They're good. They're good. They can turn around and sell the next day after the pop. Yeah.
And that really becomes problematic, I think. The incentives are just not aligned with the long-term perspective here. And that's really why we stay away from it.
Absolutely. And then, like you said, having a few quarters of publicly traded financials, how the market responds, right? The market is a collection of a lot of things. It's your earnings, it's the sentiment on your company, it's the growth potential, like what's your addressable market. There's so many factors that go into this, and you just you definitely don't want to dive in on day one. Because by the time the stock hits, right? So ARM is a great example. The stock IPOs, I think at 53 is the IPO price. It hits like 67 in the first day.
Day one,
right? Guess where it is now? 52.
Below, or below, right?
51. It was this morning. It was at 52. I think. So that's again, this is kind of the IPO idea. But ARM specifically, like they have a good market. The problem is they have some China issues also.
But I think more importantly, like people were looking at these IPOs like as a sign of like, hey, maybe capital markets are opening, because there's a ton of companies, a ton of unicorns that have been raising money privately for many, many years, are really looking to get out there and really kind of trade.
The problem is all of them happened right before the sell-off, so it wasn't a great wasn't a great, what's the word I'm looking for, omen. For the rest of the market.
Instacart, right? An example of that. Instacart also went public last week or 2 weeks ago. This is a company that raised money at $40 billion. Crazy.
Went public
2
at
years
10.
ago, right? Went public at 10. 25%.
Unreal,
right? But that's also kind of, I think they ripped the Band-Aid and said, okay, valuations really are just different. It's a different world that we live in.
Move on. Again, we tell our clients this a lot of times, like who had, concentrated stock positions or companies that went public or whatever. And just like whatever happened in 2021, that wasn't real. Like don't think of that as the watermark for your company, your stock. Could be 1 year, 5 year, could be 20 years or never that it comes back to that.
100%. And also from a behavioral standpoint, we see this in trading sometimes, right? The endowment effect, right? If I buy a stock at $10 and it goes down to 5, we get a lot of times people say, oh, I'm going to wait for it to come back to 10. That doesn't really matter. That number is just subjective.
The sunk cost fallacy.
Right, exactly.
Right? I just I'm at the blackjack table, man. I just got to get back to even and then I'll walk away. It doesn't really work.
I think one of the things we do internally when we look at companies and stocks, like, if this was today and nothing else happened, will I be buying this company today? You got to look at the future, not the past.
And how much of my money would I actually put this? If I had $1 million in cash instead of $1 million in stock, how much of this money would you put into company X? You can't even say company X anymore because that's Twitter now.
That's right. I will not put my money in company X.
Agreed. Although Bill Ackman does apparently. He wants to take Twitter public again. Because that's what we need.
It's going to go public at what? 10 billion?
Jesus. Anyway, we're going to move on from that.
We digress. So Instacart went public. Shout out French female CEO. Awesome.
Love it.
She's really
she's really good. And actually, the good part about Instacart, and I heard her talking a lot lot about this actually when it went public, is not the grocery business, because I think that's a tough competitive
Advertising business.
Advertising, baby. We know. You know what every tech company has figured out over time is whatever your business is, advertising is also your business.
Look at Amazon.
Look at Apple now. Apparently, like they're advertising their own stuff within the App Store. You know what I mean? Like eventually, you're gonna get Netflix, right? You're gonna get advertising.
Yeah. And the last one is Klaviyo, which is a kind of a marketing software automation company that's very associated with Shopify. Yep. Also went public, also very successful IPO by all measures, but also trading below its
They're all below IPO price. Now, part of that is obviously like the markets are down also, so that doesn't help.
Yeah. But again, long term, right? Like if you like this business, you got to look at long term.
You got to look at the long term, but again, you got to do work on them, and you got to wait. Like, don't be afraid to miss a pop, because in almost all, like it is astounding how much this happens, how well this happens. And it kind of, we had, I don't know if you were on this meeting last week, what we had with one of these investments companies, and we talked about small cap companies, right? Yeah. Smaller companies, and how over the long run, small companies
will do better.
We're supposed to do better. But I mentioned that over the last 20 years, that actually hasn't been the case, right? And why? So used to be, right? You had a company that went public in the 90s, or whatever. Yeah. You went public to raise money to grow the business, right? This is how all the traditional IPOs happen. Today, you can raise an infinite amount of money in the private markets, right? And by the time the companies go public, all these IPOs, one's a $50 billion one, one's a $10 billion one.
I mean, so you make such a good point. This is like the issues from the ZIRP policies, zero interest rate policies, is that, you could go out there and private equity firms and VCs will give you as much money as you want, right? Yeah. So companies don't have the discipline to really kind of go in and understand, like, hey, what's my cash burn? How do I optimize my operations to be able to really kind of grow, in a good way? So you got companies that raised hundreds of millions of dollars that just bought the markets or bought customers, and now that math doesn't work anymore, right?
Now your Instacart went from 40 to 10.
That's exactly it, right? And that model just doesn't work anymore, right?
Yeah, totally.
So I think you have a lot of companies that just kind of have to face the music and understand, like, hey, listen, we're now rates are at 7, 8, 9%. That just changed my whole operational model,
For sure. Yeah. And you're going public at this point to give liquidity to insiders. It is not to raise money anymore. Yeah, you raise money also, right? But for the most part, like, this is when companies, we have a lot of clients in tech, right? Right. We hear this from people all the time. Like,
this is our world,
preparing for IPO. We're preparing for IPO because the people who are inside 5, 10 years need a chance at liquidity.
Yeah, absolutely. I mean, listen, and they deserve it, right? They worked their ass off for many, many years.
Right, totally.
And, and they need opportunity to take some chips off the table.
But now we're talking about supply and demand, right? So we at first IPO, we released a small amount of shares, low supply, high demand. Now we have the opposite. We have over the next 6, 12 months, you have all these shares that are now available to be sold, and you're going to have an inevitable selling pressure. Again, as a general rule, this is not always the case, but as a vast rule, actually, highly general rule.
Yeah.
That's
and also, I think going back to that valuation thing, I saw this chart about the fact that anybody that invested in Instacart after Series C, so anybody that invested after 2016 actually did not make any money, So that's the problem with keep raising money and the private market, and valuations don't follow up, So SoftBank did a lot of this really shit in 2020, 2021, and they just lost a bunch of money doing this, right?
Yeah, and I think there's a new paradigm in town. Yeah. So that's our IPO market segment. I think it's just a tough space, and I think there'll continue to be more IPOs probably next year, but it won't be what we had. Like 2021 obviously was a crazy year where just everyone went public.
But also, look, I think it's nice for things to come down to back to earth, right?
For sure.
Valuations need to make sense based on the models, and frankly, good companies will emerge as great IPOs, and ones that just not very well run. Yeah. That's what it is, right?
It's Darwinism.
Darwinism.
Yeah.
All right. So let's move on. Let's talk about our favorite
Hey, man, I'm not going to say we helped do this, but our reporting of the WGA last time.
We have a deal.
We got a deal. Well, technically, it's still tentative.
Yeah.
Technically, it hasn't been signed yet, but yes, it's going to happen. Yeah.
So the Writers Guild signed a deal with the AMTP or whatever the name is, or the acronym is, with Bob Iger, basically.
Bob Iger and the Netflix people.
Yeah.
Reed Hastings.
It's great. You know, the writers have a deal. They get to go back to work.
Yeah. They get a 3% wage increase.
I think it's 5 for the first year.
A year. I think it works out to like 13% or 10% over the next 3
How
years.
does that work when inflation is 9?
Dude, well, inflation's not 9 anymore. Inflation's probably around 3.5 right now. But so they basically got a cost of living adjustment. But let's not count for the 6 months that they were out of work.
Yeah.
So not really,
probably
actually.
Negative, yeah.
So that's the thing. And I know you listen to Scott Galloway a lot, as I do.
Yeah.
Like, you know, he made some amazing points about.
He really did.
About unions.
Yeah.
And basically the slow march of death for the unions and how they're basically going out of business, essentially.
Yeah, I think the WGA did not have a lot of leverage going into this negotiation. And frankly, 5% increase over 3 years, or 13 or 14%, is not going to cut it long term. You know,
no.
They've got some nice concessions in a way, but ultimately, you know, the writers are in a tough position
for sure.
You know, and unfortunately, they're going after the wrong, they say, enemy, because the enemy is really here, especially when it comes to AI. Is really the tech companies.
The big tech companies.
Yeah, the big tech companies. And we'll reference...
But I, like, you know, and we made this point, I made this point several times in the last podcast when we talked with the rap. There's no, like, trying to fight progress is a losing battle. Like, you
Genius out of the bottle, man.
You know what I mean? Just you got to move on. And so they did get some concessions with AI.
Yeah, maybe talk about those, because that was a really good...
They got some concessions where basically, like, so the writers, like, if you're using AI and you know, I wrote something, but AI is scraping my data, I do have a right to some of that. If I use ChatGPT, for example, to aid in my script writing, I still get, you know, the credit for that. So, like, they got some concessions in that space, and I think, like, that's as good as they're going to get, in my opinion. They're like, to somehow think that you're going to stop AI from proliferating is ridiculous. Like, you know, whether I use the example of plowing and farming, you know, 200 years ago, you know, there was no such thing, right? I actually 100 years ago, when John Deere came in and was like, all right, we're gonna have this plow that works. Well, all the farmers were probably really pissed. Yeah. You know what I mean? Or the people who tended to horses when when Henry Ford started mass producing. Just, you know, we got to move on.
Hold on, isn't in England we have one of the biggest? I'll butcher this, but one of the biggest strikes was the
horse crap.
The people that pick up horse shit. They were basically revolting because cars came in. There's no more horse shit in the streets.
It was a big job. It was a big job back then, because that happened all the time, and it's just a business that just went to zero. Right? Like almost in a couple of years. So the progress, the innovation is going to happen, and you just have to accept it. And what we talk about all the time is the people who thrive are the people who adopt innovation, adopt technology, and implement it into their systems. So if I'm a writer worth anything in my salt, I am going to use ChatGPT. I'm going to use Bard to aid in my script writing ability,
or also like aid in like the remedial shit, like the stuff that you don't really like care or like to do. You know?
It's another example, right? When robots came into existence in the like 60s and 70s, big time, like there was another issue on assembly lines. Like, oh, we're not going to have workers on the assembly lines. Like,
I just finished watching Yellowstone, and like the writing in that show, Taylor Sheridan, who wrote every script by himself,
that without a writer's room.
With I don't know how it worked. I read that he wrote it by himself, every script, and there is a whole thing going on with Kevin Costner right now, who's apparently an asshole.
That is not the view of Gerber Kawasaki. We do not know if that is true or not.
I'm just reading, and this is what I'm reading. This is what I'm sharing. Okay,
you heard somewhere.
I heard. But Taylor Sheridan is like, the way that he wrote those scripts. I mean, it's amazing. I don't think AI will ever be able to get that emotional, that creativity, right? So I'm not worried about really good writers ever having an issue. Right, but the AI is gonna aid and help, you know, to create, you know, some.
It's gonna aid for sure.
I think that's where we are.
And again, the remedial tasks that you keep talking about, the stuff that we hate doing, right?
Yeah.
You know, it just makes it so much easier, right? Imagine your life if you had to go back to like setting, we have clients and we have to like talk to each one of them on the phone. We have to write down everything they do. Like technology is going to help you. And no offense, like AI, if you're a mediocre or not good writer, like it's going to affect your job. And that's been the case with technology throughout history. And as a force of history, technology is only going to accelerate ever since the Industrial Revolution, where I think we're on the 4th Industrial Revolution now, right? Like, there's no slowdown, so you might as well just jump on the train. Otherwise, the train you're gonna miss it, or it's gonna hit you.
I'm gonna be at the Rap tomorrow, which is the grill, which is the Raps conference with a lot of people from Hollywood. And it's gonna be interesting to kind of understand or hear what they see or how they see this kind of deal. I know a lot of the press is saying it's a historical deal. I thought it was whatever.
I don't think it was historical in any sense. I think they got a few concessions. I think it was a pat on the back for both sides.
Right.
And as such, everybody, you're all welcome, because the Netflix subscribers who listen are now going to have to pay an increase. If you had the ad tier version of Netflix, thanks to this agreement, the prices are going up.
Listen,
collective bargaining for you.
Netflix always make money, dude. So there you go.
But I just thought it's funny, right? Like, who pays for it in the end? We know the studios are not going to pay for it. We know they're going to pass the cost on to somebody.
Correct, yeah.
And that somebody is us. And there was a chart in the Wall Street Journal today of all the streaming services and how much they've raised prices over the last several years. And it is. Do you remember when Netflix was $8? That was just like 6 years ago.
Yeah, but also they were losing a lot of money.
$8, and now it's like it's double.
$20 now, right?
Disney and Hulu are the funniest charts. They just almost are like verticals. Like, oh, it was $6, and now it's now Hulu's 18.
By the way, this goes back to the macros, right? That was 10 years ago. Money was free, so they could do this. They could raise money out there. That's not the case anymore.
So, I mean, in Disney's case, also they use leverage to buy out this Fox thing, and it's just kind of been a mess over there.
Totally,
trying to reconfigure everything.
So I think great news for the writers, great news for Hollywood that we're back to work. I think just disruption is here to stay. It's just the reality of the game, And
in 3 years we'll have this conversation again.
Right. We have the actors now. They have to.
The actors still have to. Exactly.
Probably easier than the writers.
I think so, because I think the actors, at least for AI, the sticking point, right, is more just name, image, and likeness, right? That's the big one. And obviously, like, I agree 100%. Like, if you're, I don't know, Robert Downey Jr. and somebody's using your face, AI
should get paid.
You should absolutely have a claim to that.
And this is why, like, some kind of regulation would make a lot of sense here, whereby some IP gets protected. We have some of the rules, but they need to be updated. And I don't know if we can trust our government to do anything right these days, but I think.
Well, we have the Gates McCarthy thing. Things are looking real good.
That's another shit show there.
Things are looking real good for our government so far.
And
that's not a left-wing, right wing thing. That's just a government thing. In general.
It's just a shit show. So that's our summer recap, IPOs, rates, and getting back to work. I think Hollywood being open is great for California, great for LA. We empathize and sympathize with a lot of our clients who've been out of work really for months.
For sure. So we're excited for them.
A lot of them are excited to get back to work and really kind of get stuff done, and it's going to be interesting to see what kind of content gets created after this. But that's our future money, keeping it short and sweet this time, right?
Exactly right.
All
right, guys.
Thank you, Ayal.
Thank you, sir.
I'll see you next time.
Bye.
Bye.